Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock.
And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule one for me is I'll never own a stock that doesn't pay a dividend, ever.
If I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children had grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash.
One of the most well-known investment strategies is dividend growth investing, which is largely due to the allure of collecting dividends as completely passive income. For many individuals, it's a pretty big goal to be able to earn enough through investments and dividends to cover all or most of their living needs, while still having enough money left over to live a more fulfilling life, free of the constraints of employment. Yet, investing in dividend growth has a significant disadvantage. That is, having a sizable stock portfolio is necessary if you want to be able to totally or largely rely on dividends for your income. We're talking about tens of thousands of dollars in stocks, ETFs, to get there. Needless to say, many investors find this to be rather disheartening. If you are 30 years old when you decide you want to invest in dividend growth stocks, you choose to invest $10,000 of your funds in one of the best dividend growth stocks available. For the past 60 years, Johnson & Johnson has regularly increased its dividend payment. Same with the rise in its stock price. It should be obvious that this is a really sound investment for a dividend growth investor before you start building a more wealthy, passive income generating future. But then you realize that, given its current share price of $158.14, Johnson & Johnson stock only offers a dividend yield of 2.88%. Hence, you only receive $1.14 per share of Johnson & Johnson that you hold each quarter, or just over 37 cents a month, for each share you own. If you bought $10,000 in J&J at a share price of $158.14, you could purchase 63 shares. Your quarterly earnings from those shares would be $71.82, or little over $23 per month. Every year, J&J increases their dividends. As long as the business doesn't experience financial hardship, they will continue to increase the dividend each year. If you have the necessary patience, you'll gradually start to reap more return. Then we can find out how much Johnson & Johnson generally increases their dividend each year. They have only increased their payouts by a pitiful 4 to 6 cents quarterly. The amount of money we will make from this investment in the future may be predicted using a dividend calculator. We can estimate the yearly dividend growth rate of our dividends, which is around 6%. Considering our $10,000 investment as very simple example, if you didn't reinvest your income in the 40 years, you would have only made $44,405.73 dividends in total. If you did choose to reinvest those dividends, this means that for 40 years, you didn't spend a dime of your dividend income on something you truly desired, such as a new vehicle or a luxurious trip, and instead, you kept adding shares to your portfolio. You will have earned $78,603.12 dividends in total. Procter & Gamble, which now has a dividend yield of 2.44%, McDonald's, which has a yield of 2.15%, and so on and so forth. You'll discover a very similar pattern with other highly recognized dividend growth stocks. Indeed, you may continue to accumulate shares of the dividend growth stocks during the ensuing few decades. Knowing this information causes many dividend investors to eventually stop investing in dividend growth stocks, because they realize that their dream of completely living off dividends won't be achievable until they're gray-haired, but it seems more impossible if you want to achieve this before you're too old. Not to mention that you don't have the time for your investment payouts to increase if you're currently close to or at retirement age. You're searching for assets that will provide significant dividend income for you. Maybe you'll have more than $10,000 to invest now rather than tomorrow. Nevertheless, being a dividend growth investor is not going to be perfect unless you're rich enough to have millions of dollars in savings. A dividend growth investor can only fall into these two types. 1. People who are extremely young and prepared to make substantial sacrifices now, in order to become affluent when they are old, to genuinely enjoy living off their dividend income. 2. Those who already have millions of dollars to invest. That's why some dividend investors would prefer to keep investing and investing, effectively increasing the score, while living in a Warren Buffett lifestyle.
I'm the only person without any email, so that And I'm groping here to pull out my, this is the latest I've gotten in technology. This is my little, I really feel kind of with it carrying that around. I don't know how to use it, understand, but I like to pull it out on occasion just to impress people.
But some people may think they don't want to live as long as they can and then pass away without having had the time of their lives. With that in mind, it is obvious that you will need to focus on some other investments if you want to begin receiving large dividend income each month now rather than decades from now. It goes without saying that you should focus on assets with greater yields. Really, it is a no-brainer. But there are certain crucial considerations to bear in mind, such as avoiding stocks and funds with progressively declining dividend payouts and avoiding very high-risk investments. Individuals frequently seek the best investments to increase their dividend income as well as their share price and distribution amounts. Covered call ETFs, a relatively recent form of investment that hasn't quite taken off yet but is a treasure trove for dividends, are the greatest investment that fits those criteria. When people want to invest if they just have $100 or $1,000, covered call ETFs are always the best option. The most well-known covered call ETF available would be QYLD, which pays dividends monthly as opposed to quarterly and currently has a dividend yield of 12.1%. Understanding how options function in general is essential to understanding how these ETFs provide such large dividend yields. These ETFs use a covered call investment strategy in which the fund purchases a collection of NASDAQ 100 equities. Next, in relation to that group of equities, they also sell call options each month. Then, dividends are paid to investors from the earned option premiums. As a result, investors like us would get exceptionally substantial dividend payments each month even with some growth. Keep in mind that already has a current dividend yield of 12.1%. The ticker symbol NUSI is another excellent choice since it sells put options in addition to buying call options on its assets. This indicates that this ETF will decline on days when the NASDAQ 100 declines. The price of NUSI shares won't drop drastically. The trade-off is that this ETF's dividend yield is significantly lower. At 7.97%, it's still much higher than the national average. And using our initial $10,000 example, you could purchase 582 shares of QYLD with your whole investment at the stock's current price of $17.17 per share, giving it a yield of 12.1%. You would make around $100.76 each month with 582 shares. It's a lot better than the $23 a month from Johnson & Johnson. Imagine the amazing snowball effect that would result from choosing to reinvest those dividends each month in the development of a sizable income-producing portfolio. As alternative, when you can entirely rely on your dividend income, you might decide to reinvest your dividend some months and spend it in other months. There is another terrific investment that offers investors bigger dividends. Business development companies are one of them. Since 1980, these firms have essentially been providing loans to small and medium-sized enterprises to aid in their expansion and development. These small companies must provide the BDC a portion of their income in exchange for funding, and the BDC is legally obligated to return 90% of the funds they receive from these companies to shareholders in the form of dividends. Dividend yields of above 8% are not unusual for BDCs. Some of them pay monthly, but the majority usually pays on a quarterly basis, which is still acceptable, provided the company is still giving out sizable dividends. One of the famous stocks in the BDC industry in particular is Ares Capital, which is the world's largest business development corporation as its ticker symbol, ARCC. The dividend yield on this one is a whopping 10.49%. Covered call ETFs and BDCs are only some of the investment types out there that pay large amounts of dividends. There's more that are worth looking into, such as real estate investment trusts, closed-end funds, master limited partnerships, and so on. The focus of living off dividends soon with limited funds mostly centers on aggressive dividend investment. Reinvesting dividends as frequently as possible will help you build up your dividend portfolio significantly faster if you want to live off your dividends much sooner in life. When you employ this method, you'll be astounded at how much more driven you'll be to invest in dividends. There is undoubtedly an emotional component to dividend investing with this manner if you were to see QYLD giving you $100.76 each month while Johnson & Johnson gave you $23. We appreciate your watching. Please hit the like button below if this video helped you in any way and don't forget to subscribe to the channel. Thanks again and see you next time.